This is The Language of Business with Greg Stoller.
The term PE, or private equity, is tossed around almost as much as a basketball is during a weekend pickup game. But what does it mean? Steve Segal should know he has 20 years of investment experience with J.W. Child Associates and is an executive in residence at Boston University. Steve, welcome to The Language of Business.
Thank you, Greg.
So why is the term private equity really private?
Well, it's private because the companies are private. So if you want to contrast it with public companies that people know well, those are companies where shares are freely tradable on an open market like the New York Stock Exchange, and you can call your broker and buy stock. But in private companies, you can't do that. They're owned by somebody else. If you wanted to buy a pool of public stocks, you would go to a mutual fund and you'd buy some shares in a mutual fund. Well, somebody's managing that mutual fund, and that mutual fund is buying stocks on a public market. A private equity firm is like a mutual fund where its investors are all institutions, and then they take that pile of money, and instead of buying lots of shares in public companies and trading them, they're buying the whole company. And they might buy 12 or 15 companies and own them for a longer period of time, try to influence the management, influence the direction of the business, try to improve the profitability, and then sell it in maybe 3 or 5 or 7 years.
So if a private investment group got together and bought a larger company, but they weren't institutional investors, you wouldn't necessarily describe that as private equity?
There's no technical definition. So private equity, again, could be private equity as the broad umbrella and venture capital and leveraged buyouts as two subsets of that. Frequently people say, well, venture capital is one category, private equity is another, and they interchange those names, private equity and leveraged buyouts.
If the companies are private, does that mean that there's not as much regulation?
Let's break it down into two pieces. You could have a startup company, those are private too. So think of things like Facebook before it went public, or Google before it went public. These are obviously well-known public companies now, but we all know them as private companies too. So those private companies were owned by venture capital firms. Those companies themselves were unregulated. However, private equity firms today, because of some things that happened during 2008, we've gotten more regulated. And so private equity firms are regulated to some extent like mutual funds. The investors in a private equity firm are typically pension plans, endowments, college endowments, foundations, insurance companies, wealthy families. So if a wealthy family is invested in a private equity fund, that wealthy family is not regulated. But pension plans, we know, are heavily regulated.
Because you rely so much on institutional partners, are the profit margins better at all?
Well, the profit margins for the private equity firm are excellent. And this is where maybe some people will say that the incentives aren't all that well aligned. So if you buy, for example, a no-load, low-fee mutual fund, and advisors will tell you always to buy the lowest cost investment alternative you can find, particularly when you're buying public stocks or indexes. Private equity firms, on the other hand, like hedge funds and venture capital firms, typically charge a 2% management fee and then 20% of all the profits. So it's very profitable if the performance is good for the private equity firm.
The performance of the companies that they're purchasing.
Exactly, the performance of the portfolio that they've invested in. If the performance of the portfolio they haven't invested in is very poor, then the firm doesn't do very well. True, they collect their 2% management fee, but they get none of the gains because there aren't any gains, and they've also invested alongside of their investors, so they would have lost money in the fund.
What would the ROE be, return on equity be, for private equity as opposed to venture capital?
So in a public company, if you don't like the investment, if you don't like the management team, you simply sell your stock. In a private equity investment, if you don't like the investment or you don't like the management team, you've got to do things. You can't just sell your stock. That's a big process to go sell that company. So the money is tied up for a much longer period of time, and it's considered to be higher risk. So therefore, the target rate of return is higher.
Where do you see PE competing with VC?
They don't really compete. There's some overlap. Certainly some firms will do a little bit of both. If they're kind of in the middle of that later stage venture, they might buy more mature businesses. Typically, firms have a very set specific strategy, and that strategy will tell investors, this is what I'm doing, so that the investor knows, okay, I'm locking up my money for a 10-year period of time or maybe a little more. I want to know what this investor's focused on.
And where does mezzanine financing fall with this entire alphabet of finance?
The private equity firms that are buying these companies are buying the companies with the help of leverage. They're using debt capital to buy the company, much like we would buy a house. You put your equity money down, maybe it's 20%. Now for private equity, it's more than 20% these days. But if you're going to buy a house, you have to put a certain amount of money down. That's your equity investment. And then you have to go borrow the balance. Private equity firms do the exact same thing. They put the equity money down, and then they have to go borrow money. That money can come from a bank. It can come from the public high yield markets, or it can come from these mezzanine financing sources, which provide junior capital. So when we go and buy a house, we're just finding one source of debt. It's the bank, and that's the senior lender. But if you're buying a company, many times that the top end of that capital structure is stratified, and you'll have senior debt and junior debt and then equity. And so that junior debt, that's where the mezzanine fits in. And that mezzanine capital can be provided from, again, insurance companies or private mezzanine funds.
And the senior debt would come most likely from banks?
Typically banks, but they can also come from what's called collateralized loan.
CMOs, collateralized mortgage obligations,
Right, more of the alphabet.
Right. Yeah. So what you're saying is junior debt would be subordinate to senior debt, et cetera.
Correct.
Steve, thank you.
Thank you, Greg.
Steve Segal, a former founding partner of J.W. Childs Associates and an executive in residence at Boston University.
Coming up, is your banker a short-term or a long-term partner? But first, why would you use your attorney for financial advice? Next on The Language of Business.